Okay, everybody, I'm going to go through problem 8-7 here. Let me make sure that the microphone is not too loud for you. I'll try to speak softly. It looks like it's pretty loud, but I'm going to go over an investment pool trust fund here. Albertville's City Council decided to pool the investments of its general fund, the Albertville schools, and Richwood Township into an investment pool managed by the city. Each of the participants had reported its investments at fair value at the end of the last fiscal year. At the date of the creation of the pool, the fair value of each participant was as follows, and it lists them here for the total. And it's important to note here that the general fund is an internal fund, okay? Which means it's going to report its own interest in the investment pool on its own financial statements. And so the investment trust fund is not going to report an increase in its net assets related to any investments that are allocable to the Albertville General Fund. Speaking from the perspective of the investment trust fund, again, the city schools and the township are going to record the investments on their own books, but the investment trust fund is also going to record an investment or a increase in its net assets on its books, as opposed to the amount that's allocable to the general fund. It's going to record a liability, and you'll see that in a minute. It'll make more sense. Okay, so we have to make, first thing we need to do is we need to calculate the proportionate share. We're going to need this in a second. So we're going to need to calculate the proportional share of the of each investment pool based on their share. And so let's go here and let's do equals that divided by that, and let's give it a fixed, an absolute reference for the total there. All right, so we got 10% is Albertville. We have, the general fund, the cities, the schools is 47, and I actually think I'm not sure if it's exactly 47 or, yep, exactly 47%. Okay. So we have to make the entries to show a new asset account, equity and pooled investments, closing the existing investments account, and debitoring or crediting revenues based on the change in the fair value. Okay, so, and sorry I didn't do this before. Let's split the screen so we can keep our items up there. And let's filter out this. All right, so we'll start with the Albertville General Fund to record its entries. And we have here, let's start with, we are going to debit equity and pooled investments for $900,000, because that's the current fair value of what's going in for the Albert General Fund. We're going to debit investments for the old value of $890, and we are going to record revenues. Let's see what that revenue account's called exactly. Sorry, revenues. Should be change in fair value of, there we go. Change in fair value of investments. And this is in the Albertville General Fund. Okay, now let's go to the schools. The schools, we are recording the new investment in the equity and pooled investments for $4230. We are removing the old investment for $4.2 million. Sorry. and we're recording revenues, change in fair value for the difference of $30,000. Okay, and we know we're going to use the same accounts here, although we're going to have a, you'll see we're going to have a debit. Since it's a change in fair value account, you don't use a separate account for losses and gains and stuff like that. It's all just going to be revenue. You're either going to debit revenue if it's a loss or credit revenue for a gain. So let's record our new one, 3.87. Remove our old one for 3,890, and you can see there we're left with a $20,000 credit balance on that entry, so we need to debit the revenue change in fair value of investments. So now we're going to move on to the actual investment pool trust fund, okay, in the next problem. Let's see, showing the general journal form. Oh, yeah. All right. So here we go. We're showing in general journal form the entries to be made in the accounts in the investment pool trust fund. All right. So we have to, in the first one, record the assets, the current fair value of the assets that were transferred into the pool, and assume that the investments of the city's general fund were in U.S. Treasury notes, and investments of the schools and township were in CDs. All right. So what's interesting is why they choose on this problem to match up like exactly, because that's the point of a pool, is that match up exactly, like saying that the Albertville General Fund's part of the investment was invested in U.S. Treasury notes, and the other two amounts were invested in certificates of deposit. Like, that's the point of a pool, is you put your money in and you get units or shares of the overall pool, and it doesn't matter what it's invested in. It doesn't like have to match up exactly, but for some reason they decided to do that in this problem. So our first account here, we'll go ahead and do the U.S. Treasury notes. We'll do our debits. So it says the Treasury notes part is what the general fund's investment went into. So that's $900,000. And certificates of deposit, we got, again, these two added together, since they said it's for the township and the city schools. Amount went into CDs is $8.1 million. Okay. All right. So again, because the general fund is an internal participant, and this is not going to be recorded as an increase in net assets of the investment trust fund, it's got to be a liability. And let me show it to you really quickly on your textbook. Let's see here. Town of Brighton. No, what? Sorry. Well, let me get you this textbook here. And sorry about this. Let me go back up. Oh, I was looking at something else just a second ago. Go back here, because I just saw it, and it'll kind of demonstrate what I'm talking about. All right. Here we go. Yes. All right. See, on this, the investment pool, it's showing the amount that's due to internal participants. It's showing as a liability, but the amount for this Drew County that's held for external participants are treated as net assets, or like equity accounts. So that's where That's where the difference there is coming from, or the difference in treatment. I just wanted to illustrate that for you. All right. So, sorry. Back to the actual problem. We have back to the actual problem. We've recorded our two assets there, our two investments. So now let's record our credits here. So $900,000 is a liability due to the general fund, and this account is kind of like an increase in net assets type account. Sorry, I have to make sure I know how it's spelled. Additions, deposits. So we're going to have a few different types of accounts, all that start with additions. Okay. Additions Albertville Schools, and additions for deposits for Richwood Township. And that's $4.23 million. And this is 3870. All right. Number two is CDs that had been recorded at fair value of $1 million matured. The pool received $1,050,000 in cash, $1 million for the face of the CDs, and $50,000 interest, and the entire amount was reinvested in new CDs. All right, so let's record the receipt of the cash, 1050. All right, and let's remove the old certificates of deposit of $1 million. And this is undistributed earnings on pooled investments, because we haven't allocated it out yet to the various members of the pool. So it'll sit there for now. You'll see later we'll reduce that liability. All right, now we got to turn around and reinvest it. So certificates of deposit, 1050, and cash is 1050. Okay. All right. Number three says interest on treasury notes in the amount of $50,000 was collected. All right. So again, we've got cash, and we have undistributed earnings on pooled investments, again from our revenue that we've collected, or our interest revenue, but inside the pool it's going to be distributed. All right. Number four, interest on the CDs at year end amounted to $28,250, and so this is accrued. And so the investment trust funds use a economic resources measurement focus, which again uses accrual accounting, not modified accrual accounting. And so we're going to accrue some interest receivable that's due on those treasury notes, $28,250, and we have some more undistributed earnings. All right. 5 is we are going to compute the pool's liability or net assets for each of the three participants for its proportional share on the earnings of the pooled investment. And you're supposed to assume there were no changes in the fair value on the pooled investments to date. All right. So we need to go back up here. What's our amount here? All right. So let's see what our undistributed earnings balance is. We've got $28,250, $50,000, and $50,000. $128,250 is our total. Okay. So let's go back up here. And let's calculate, since it said there hadn't been any change, assume that there hadn't been any change in fair value. Let's take our amount, and let's take this, multiply by this. Don't forget to make our cell reference absolute. And let's copy it down. And we'll round those when we're actually posting the problem. Let's see here. Let's go ahead and round it now by, we'll do this one as 6278, and the other one is 55,147. Okay, so let's go here, and let's record. We're going to reduce our liability $128,250, and we're going to actually allocate it to the different specific members of the pool. All right, so when we're allocating to the general funds amount, the $128,825, we're increasing a liability. All right, because they're an internal participant. For the others, it is going to be another additions account, and it's going to be these investment earnings. So let's go ahead and do this one so I don't have to. All right, so Albertville Schools is 6278, and the Richwood Township is 55,148. Okay. Looks like 147. I forgot to round that one down. Okay. So let's see. Am I missing an account here? Additions. I just must have had an extra line here for some reason. Oh well. Now, so the next problem is going to ask us to. Next problem is going to ask us to record each participant's funds. Each of the participant funds, the increase in the equity in the pool, and so we're going to record the flip side of this same entry in the individual funds account. Okay, so for Albertville General Fund, we're doing equity and pooled investments just like we did earlier when we recorded the initial investment, and it's revenue, just like the earlier one. Not like the earlier one. The earlier one was change in fair value. This one is revenue investment earnings. Okay, and it's going to look exactly like this for the other two. You see what I mean about internal versus external? That's only relevant for the financial statements of the investment pool trust fund, not each of these entities. They're still going to record the earnings from the investment as well as the assets as investments on their books. But on the investment pool trust fund, the City of Albertville General Fund is what's going to be presented as a liability, so that it will kind of wash out with the general fund when those financial statements are prepared. All right. So let's go to letter D, which says the Albertville General Fund decided to withdraw $100,000 from the investment pool, and it says they needed it to acquire capital assets. The investment pool sold $50,000 of its investments in the U.S. Treasury notes to obtain the cash needed for the withdrawal. Record the sale, record the cash withdrawal in the investment pool trust fund as well as the City of Albertville General Fund. Okay. So first, we're getting ready to make the withdrawal, or to send the money to the Albertville General Fund. So they said we had to sell Treasury notes. Yeah. Okay. That's us getting ready. This is not hard when you just kind of take it step by step. Now we're actually going to send the cash out the door. So we're going to reduce this liability due to the general fund, and we're going to send the cash out the door. Okay. Now we're going to record the receipt of the cash in the again, it looks like I have put too many rows here for my this is supposed to be general fund. Let's do that. This is record receipt of the cash in the general fund, and it's 100,000, and this is 100,000. Sorry. Okay. So that's D. All right. So now we got one more thing. No more journal entries, but one more thing here. we're supposed to recalculate the revenue, the participants' proportionate share. All right. So we started out with these balances when we first invested in the investment pool. Okay. So now let's go to the we need here to record the various changes in the investment account balances. Okay. So we have here we've got two transactions that impacted the general fund. We have the investment earnings that came in, as well as the $100,000 reduction on the withdrawal. Okay, so let's do that here. We've got plus 12,825 and then a minus 100,000. Okay, which is let's turn all these into except this is going to be a percentage. Okay. So the new amount is going to be this column, which is going to equal that plus that. Okay. And our new proportion we're going to calculate over here is equals that divided by the total here. We're going to make an absolute reference, 9%. So these don't add up yet to 100 because we're, well, yeah, they do, because we're still, on the additions and reductions here, we've got now, for the Albertville schools, we've got 6278. Remember from our entry down at the bottom here with our investment earnings, and we've got 55,147 for the Richwood Township. So our new allocations, and it's actually, this really does have a, our new allocations here are here about 44%, 48%, and 9% for our various accounts, for a total of, well, oh, because this is not a formula. I was wondering what's going on here. This needs to be a formula down here instead of just pasted. Yep, there we go. 90,028,250 is our total there. All right. So yeah, we've recalculated, and so we'll use that as the basis for future investment income allocations. Okay. Now, the last question says, explain how the investment trust fund will report the general fund's interest in the investment pool and the Albertville schools' interest in the investment pool. Okay, as we've said a couple times, general fund is an internal participant, and so it's going to record it. It's not going to report it in its financial statements. The investment, it's a liability. Okay. The general fund would report its interest in the investment pool, but the school, since it's an external participant, the investment trust fund is going to report the school's interest in its statement of fiduciary net assets and the statement of changes in fiduciary net assets. It's a liability for the general fund's statement, and those are netted out together. But for the external participants, it's actually treated as an increase in its net assets because the overall city's financial position is higher with those external participants in its investment pool. Okay, even if those resources can't be spent on whatever it wants to. Okay, so that's why the different treatment there. Hope this was useful to you. Thanks.